All right, everybody, welcome to Hobby Weekly Market Chat. I'm Johnny from Hobby Research. Today we have Dave, also from Hobby Research, my partner, and today we are going to cover some interesting and exciting topics, which will include a current market overview. We'll look through the accumulation of Bitcoin and also Ethereum, I would say the fake pump and also the rally of the two. And then we are going to explain are they in a distribution phase right now, or if they are still have a way to go. And then we'll look back to the Wyckoff accumulation pattern last week, and then moving on to we will have some explanation on the Fed balance sheet and some explanation on the expected inflation rate, and also we'll look at some commodity prices to see if the inflation rate is being brought down. And then lastly, we'll have some macro analysis, and also we'll give some news and some other important dates that we have to pay attention to. For example, the FOMC meeting. And lastly, we will have a section covering a very interesting chart of crypto market cap VS versus global monetary supply. I'll say M2, and I will explain more in the last session. And last but not least, we have the candy drop. So make sure you stay tuned, and also you have your trading on our Hobby app. And let's start today. The first topic we're going to do is a market overview. Monday dump, Monday pump. Which one's bigger? Probably Monday dump, right, Dave? And then we're
Yeah,
going to look at, yeah, let's look at the chart of Bitcoin and Ethereum to see how things going. So just a minute. Let me switch to the Ethereum chart. Yo, so we're currently, yeah, we're looking at the Bitcoin chart right now. So just a minute. Okay, so remember last week I explained that we were in a potential accumulation phase, but obviously at the moment of truth we failed, right? The accumulation failed right here. Let me zoom in a little bit so you can see what's happening there. Okay. So the scheme played out quite nice, I would say, in the first beginning, in very beginning, the selling climax, and then moving on to testing the lower boundary, and then to the spring, we could see a quick backup. The spring, I would say, you could notice that demand stepped in here on the day the CPI pump, and then we pushed all the way through, and we broke the trending line here, and we show some sign of strength, and after that uh, something bad happened. I would say you could see a significant volume of prices being pushed down. We could see bigger red candlesticks, and as it pushed up again, it could not form a higher high, and also it formed a lower low with we could obviously observe that the bearish side, the selling also supply was obviously greater than the demand side, and that's why we think that the accumulation phase probably failed, and we are now in a distribution phase, and probably smart money is accumulating shorts right now at the top position. As we could see, it tested the channel line, and then it got rejected, and prices got pushed down significantly, and now we are down to 21K. And probably as the GDP release tomorrow, the day after tomorrow, and then it will be some it will be we are actually pessimistic about the release, because we'll talk about it later, so make sure you stay tuned. We'll talk about it later, but right now we are seeing the Bitcoin price is not going bullish. A lot of bearish development happening here. And let's look at the Ethereum chart. Same thing happened. We were in a quite nice accumulation phase, I would say, here, as we push up from the selling climax to automatic rally, and then push up to the secondary test, and then we had another secondary test here. The terminal shakeout was on the date of the CPI release, and then we had some really nice uptrend development until then. we are seeing some distribution up there. And for the Ethereum distribution part, we'll talk about it later. But let's lay out, we have an overview that we are entering a bearish environment in the crypto space. So let's get back to the market overview here. So let's look at another interesting topic that we are going to discuss here with Dave. It's the Federal Reserve balance sheet, and there have been some saying that the Fed has been adding some mortgage-backed securities, and since June of 2022, the Fed wanted to bring down the inflation rate, and by doing quantitative tightening, and in order to curb inflation, the Fed had to make the banks put their money parking with the Fed, so that they don't use the money to spend outside and to invest outside, and that's why we are seeing money coming back to the Federal Reserve treasuries. However, as we look at the right hand side of this slide, and then we could see that as you can see my mouse, and then we have the mortgage-backed securities here adding 330 billion last week. There's a positive change. We could see an increase here. This is interesting, right? Because the Fed wanted to to curb inflation, and why would it add mortgage-backed securities on its balance sheet is interesting, right, Dave? What do you think about it? Do you think can you explain what's happening here? Why is the Fed adding mortgage-backed securities? Why is the Fed buying buying this security?
Yeah, absolutely. So, the first I'm gonna talk about the MBS purchase. So, what is MBS? It's basically mortgage-backed security. So, what are they? They are just, the securities like equities and stuff, bonds and stuff. They are backed, by the mortgage. So, mortgage is like a housing market, a sort of leverage field of the financial instruments. So, what you wanna have take away with the audience is like basically the Federal Reserve always has to purchase or buy the MBS bonds or financial instruments to stabilize the market, to reduce the volatility. So if there is no purchase or there is no elasticity of purchase or selling or buying or stuff on the bonds, the volatility is going to be high, and we can put a economy of the U.S. or the America into like a volatile junk of paper, or a lot of weight. So the Federal Reserve has to purchase them, but it's like for example, it's like the second thing I would like to point out that is the Federal Reserve is going to have a quantitative tightening policy. So if we consider the tightening, we have to consider the whole picture. That is the Federal Reserve going to reduce the size of the whole balance sheet, and what's the size of the MBS purchase, or what's the size. So if the MBS is like a billion purchase per month, but basically the Federal Reserve is basically reducing like 200 billion of the balance sheet size value. So basically, the Fed is doing a good monetary policy that is tightening and deflating the U.S. dollars. So basically, it's great. So when if you're the trader or investor, no investment advice though, it's important to see the whole picture, or the picture as a whole, that the macro analysis and the micro analysis to be combined together. So if you see MBS purchase, yeah, they're printing money out of thin air, but at the same time they're doing the tightening. So we have to check, and we have to take a look at the whole picture. So what do you think, Johnny?
I think you're right, and adding 330 billion to the balance sheet is actually there are. I think there's another purpose for this move, is that as the Fed raised interest rate, the activities for housing, we for housing refinancing. So people before when the interest rate was really low, and then people could take out money from their mortgage, and then they could do investment with their money. And right now, these kind of activities, the number of these kind of activities decreased significantly because of the high interest rate. They couldn't afford they couldn't afford the interest, and that's why as there have been less financial activities with regards to the mortgage-backed securities, and that's why the Fed had to step in, to stabilize the market. And I think it's totally reasonable for the Fed to do this, to stabilize the market at the same time, tightening the monetary policy, and also to shrink its balance sheet, at a steady rate, because the Fed, the Fed won't want to do a hard landing. We don't want to crash the market. We probably want to do a soft landing. So by doing so is to slow down the growth of the economy a little bit, steadily, hopefully, but not to impose too strict monetary policy on the market, or else we're all gonna face severe losses and got hit very critically. So let's talk about the left hand side. We have the Vanguard analysts, projecting the optimal balance sheet estimation from 2020. You can see that our balance sheet increased from around 4 trillion to now is 8.5 trillion. That's a double, and it's I think it's I think it's one of the major issues causing inflation, because when you increase the monetary supply, and people with more money, they have more consumption power to purchase commodities, investment, and all sorts of things. And doubling the balance sheet is definitely boosting economic growth, but on the other side, too much inflation isn't good for everybody, because we now been facing very serious just like gas price. I can't even drive to work because the gas price is too high right now. And too much inflation, right? And that's why we have to to bring down inflation, so that more people could afford the commodities like gas price, and also some other stuff. So Dave, you have anything you want to talk about regarding the projection of QT, and anything about balance sheet you want to talk about?
Certainly. So, yeah, like inflation is, like too high, I guess. It's basically
Yeah.
a sense to everybody that, the gas price, food price, and whenever you travel to the States, the food is like 30% higher than the last time you traveled there. So basically, it's making it hard for everybody to live. But return back to the balance sheet. So, according to the Vanguard analysis or the publishment or the published article, so we tend to see that there is like we're now like like 8.5 trillion balance sheet Federal Reserve. So before the 2020, like the COVID print of the ultimate monetary supply, we tend to have 4 trillion of total money supply size. So basically, the Federal Reserve is aiming at the ultimate goal of tying until like 4 trillion, at 2027. So basically, like 50% reduction. So if you see something like this, you're basically having most of the assets, having like 50% of the value, or 40 or 30 percent value decrease, and for some even like risky assets like meme coin or like meme stocks or like or stocks, stuff, they are going to crash a lot because it's styling. So what I want to have takeaway with the audience is like, before betting on anything, it's like you have to classify if that is a risky asset or a valuable or a nominal asset. Or risky asset is basically like you're betting on the future revenue growth, whether the revenue is going to have a turnover and to generate EBITDA for the whole company. And for the other side is the valuable or nominal company. You're basically betting on they're going to have a healthy financial status or a healthy EBITDA, revenue growth with a good amount of outstanding shares, like price to sales ratio and stuff. So back to this, like betting on the balance sheet is like if you have nothing, people are going to bet on, assets that are less risky, the assets that have more valuable, insights with the whole company or the equity or even the token. So basically that's what this is my understanding about tiling bet. So what do you think about tiling policy and the future of the cryptocurrency market, Johnny?
As you mentioned, I also agree that crypto is definitely a risky asset. The volatility is great, it's high, and personally, I like this volatility because for trading, we trade on volatility, right? The more volatile the asset is, and then the more opportunities that we could make a bucks out of it, and that's why I personally I'm still stay in the space, like in the crypto space, because I just like this space. I like this industry. I like the culture. And but it's different than investing, right? Trading is different than investing. We know the macroeconomic environment is not good, and it's not the proper time, and also the optimal time for doing an investment. But trading is a different thing, right? And you could actually make money during bearish market, and also you can make money in bullish market. In bullish market, everybody makes money, right? just by just by holding, and then but in bearish environment, it's not for investing because the value is dropping. The only way that you can make money is doing shorts. And yeah, right now, the Fed is definitely going to further tighten the monetary policy because too much inflation. As I mentioned, commodity prices high, and that's something we have to fix right now. Too much inflation isn't good for everybody. Dave, do you have anything you want to add in here?
Like I think so. So maybe we'll just catch the time, jump on
Yeah, of course.
inflation's ending.
Yeah, and then let's talk about the inflation issue. So we can actually drill down to drill deeper into by what means the Fed curb inflation. How does it do that? Maybe we can talk about it. Dave, can you explain to our audience? We actually, I think we already mentioned a little bit about it.
Cool. So how is Fed is gonna curb inflation? It's basically I gotta explain where inflation comes from, and basically what the Fed is going to do. So inflation basically comes from to my sense of understanding on the financial instruments. The market is basically like you print money, and the money is borrowed out at a low cost, and people use the low cost to develop more business, more economic cycle to extend the economic development. And at the end of the day, basically you're like the money comes out of the goods and services and inflate to the market because people have revenues, they want to spend more, and at the end of the day, they drive a bit up of the like food and beverage prices. But basically this is not happening with an extreme case of inflation. But an extreme case of inflation is basically heavily related to a lot of money printing. So basically what the Fed does is like they print like a 4 trillion of market capitalization of the whole Federal Reserve balance sheet. So let's jump on how the Fed is going to reduce or curb inflation, reduce inflation rates. Basically, first is like Fed is going to reduce the whole size of balance sheet by a bunch of methods. The first is reduce MBS purchase, like the mortgage-backed securities. They are going to reduce the purchase size each month or slowly decreasing. We're stabilizing the market and also decreasing the the whole size of the purchase. The second, the Federal Reserve is going to increase the repo. it's like the reverse repurchasement agreement. So what is a repo basically is to the repurchase agreement is basically to promise to to borrow your money and promise to sell at higher prices. So to the audience, it's like you can think of if Federal Reserve is reducing or is reversing the repurchasement agreement. Basically, the Fed is reducing the market liquidity of the banks or the reserve in the banks. So basically, if the banks do not have a lot of liquidity or as much as liquidity as before, and for the investor or traders, they're not gonna have more bets on the risky assets. And basically, for this purpose, as reducing the size of the bank reserves and a lot of like M1 and M2 and stuff, they are doing that and reducing balance sheet. And then basically the third point is to, directly to just, reduce the Federal Reserve balance sheet, but take away the liquidity from treasury bills. So what do you think about that policy, Johnny?
Yeah, basically what Fed is doing right now to curb inflation is to get back the money the Fed purchased, just printed last 2 years, and by purchasing a lot of commodities and other securities, and then the money, was excreted into the market and was circulating out there. Right now, the Fed want to get back the money by doing so, just like what you mentioned, the reverse repo repurchasing agreement, and maybe the audience wouldn't get it because it's a bit technical, I think. But I can put a metaphor so that you guys can understand, what it means. Just like maybe Dave is someone with a lot of money, and that's similar to the banks out there, because in 2020 and 2021, I'm the Fed and I printed a lot of money and I purchased a lot of commodity securities from banks, and then now the banks are rich, and I want Dave, the banks to keep that money with me because I don't want the money to be circulating out there. So I want to offer something attractive here with that. I want the investors to invest the money with the so-called the securities I offer. One of them is the reverse repurchasing agreement, and this is I think that it's a borrowing that I purchase. I purchase the securities from Dave, and then I promise that I'm going to sell it at a high price for you. So it's like, hey Dave, come get your money here. I offer you very good interest, and then you come deposit your money here, and then you get back with some extra money, and that's why the banks will stick with the Fed because of the attractive interest rate, and that's why that's how it raises the funds, and how it affects the whole market, because banks would prefer staying with the Fed because this as I would say, this investment is way better than putting the investment also with risky assets like stocks, and also growth stocks and crypto, because that's risky. They might lose money in investing, but investing with Fed, what they offer is risk-free risk-free securities, and that's very interesting to them, and that's why that's how Fed is keeping the money with them, and discourage them to invest money in the market. Yeah, and that's what I think about the R piece. And Dave, you have anything you want to discuss with me?
Basically, let's jump on to the like White House, recession
Yeah,
definition.
that's interesting news. Yeah, that's some interesting news. It's weird,
Yeah,
right?
so basically, yeah, it's weird. Like, yeah. So, Carl, let's get back to what's the thing is happening. It's like, so right now we see or we read an article. So the article said that how do economists determine whether the economy is in a recession? So basically, this according to a technical definition of the GDP is basically like for two consecutive quarters, if there is a consecutive, negative GDP, we're going to have a sort of like technical depression, because like the American or any country who has that, negative GDP for two consecutive quarters are not producing enough, or does not, have a positive gross, production. So if that happens, we will technically call it, like the technical recession. But White House is trying to change that definition, these days, like just like a week ago. So a week ago, we tend to see that they're trying to say that even there is a two consecutive quarters of falling real GDP, it doesn't constitute to a recession. So basically, it's like a shady area. Um, sort of like it's new to me, but sort of they're changing their definition and the perception of the traders or investors. No investment advice though, but we tend to see a, if there is a release of the GDP in the coming future, and if that GDP is going to have a consecutively, negative to be a, a monthly or GDP, like quarter over quarter, growth. So we are, basically call it not a recession scenario. So what do you think about this sort of recession or this sort of GDP growth to you, Johnny?
After reading this news, I'm so suspicious. You know what I mean? Because why is it trying to redefine the definition of a recession? I don't understand, because maybe the White House trying to defend themselves being criticized with bringing the economy in a recession, and that's why it just change the standard and change the definition of recession, and then people criticizing will be false, will be wrong, right? It's not a recession. It's actually technically it's not a recession. It's just a slowdown of our economy, and everything is good. It's going well. We don't have to worry about it until we see the red candlesticks going so big that broke our desktop. And that's something that I wouldn't want to see in the future, because in my opinion, the day after tomorrow, when the GDP data is released, the second quarter, I think it's gonna be a falling GDP, because the White House already told us it's not going to be good. Then that's why the White House changed the definition of recession, so that we don't have to criticize. Right.
Yeah, cool. So like, basically, I don't want to have comments with the Federal Reserve, but I also don't want to have like a predictive comments. But basically, if they change that definition, I think some sussing
Yeah.
facts are going on. So do you have anything to add on here?
Now maybe we can just move on to another interesting thing. Right. Yeah, another topic. So we are seeing, just in the beginning, I mentioned that we are seeing a distribution pattern of ETH during its time, trading between 1400 and 1600. And then maybe Dave, you could explain a little bit about the volume and also the distribution pattern that makes us think that it's not going bullish.
Yeah, cool. So basically, we were very bullish when it was like 1K. So basically, we published like two articles, and both of them are saying that we've found a local bottom by a lot of like stream indicators, a stream index that we developed ourselves, and we also with the white curve accumulation pattern that nicely played out. But like at a point of like like 15 1.5K. So at this point of price, or this level of price, we tend to see Ethereum just goes in the channel of sort of like accumulation or distribution. So at the moment, I'm just finding out. I didn't have an answer. So basically, when I look at the chart, it's basically like if we have morning star. So Johnny, if you have the pointer, you can point for the audience. So if we have a like a shooting star, that we have a volume that is signifying the shooting star to the top. So basically, we're seeing a sign pattern. So to reverse, to hedge our opinion that if we were wrong, so we tend to see if there is any volume signature or a large volume buying at the bottom of the channel. So basically, we have sort of like very significant volume that is selling out of Ethereum, outside of the range, at the top, instead of buying, Ethereum at the bottom. Like you can see it, refer to the chart. It's like there are at least 3 points that the whales or some, wealthy or holding a lot of ETH, they are tending, they have tendency to sell the ETH, at the top. So what do you think about this distribution pattern, John?
Yeah, of course, the whales are going to take profit at these high levels, right? Because they purchase down at 800, 900 at the bottom. We could see a very nice accumulation pattern formed there, and that's a lot of it being absorbed there, and they are going to take profit here. It's very reasonable. The price almost doubled, like 50% to 70% gain, right? And then what Dave just mentioned is that the signature volume at the top, we have to be careful of these signals, because while when price is pushed upward to the top and the volume is, we see a spike in volume, and that means that that particular price level is very important, and after that the price is being pushed down. And what it means is that the demand was actually absorbed by the supply. The supply was so great that at that time the supply pushed down below, and then we see three consecutive events happening here, right? Three push down here, and that's not a bullish sign. And we could see bigger red candles, bigger legs down instead of bigger legs up, right? And that's another bearish sign that we observed here. And then yeah, the volume signature actually, tell us a lot about, is it a reaccumulation or a distribution. So right now, if it's trading around 13K, obviously is a distribution pattern being played out. And for if price is going to being pushed down further, we have to analyze the macroeconomics environment, because as we've mentioned, if most of the investors prefer less risky assets, and then we wouldn't see an inflow of capital inside in the crypto market, and that's not optimistic, and that's not bullish for all of us. Yeah. What do you think about, Dave? You have anything you want to talk about me?
Yeah, I think you're pretty much right. So we were actually very bullish like a week ago, and then we see a distribution balance Sunday and Saturday, completely like a behavioral play off. It's like you just distribute it when people are sleeping at 12, and just pump it when people are just waking up at like 8 or 9. It's like basically a behavioral trading pattern. So if we see that distribution pattern with behavioral pattern, it's basically a trap. So on Sunday and Saturday we just did some actions. So do we think we should jump into this sort of like Wyckoff distribution scheme analysis?
Yeah, let's go. From the right hand side, we have a more detailed plan. Maybe Dave can explain a little bit, about how did the distribution scheme being how it was played out during the high prices level.
So basically, when you see the lines I draw, on the left hand side of the channel, we basically see that is on a not a vertical but semi horizontal to horizontal channel. That's a flip channel, and then in this flip retracement channel, what I call it, is basically like we tend to see have a BC at the first peak level. Then there is a UT, that is the UT is basically same level with the BC. And then we have the third peak, from left hand side to right hand side, we have the UT80. And this UT80 is slightly above, all the other, peak level. So we tend to see, we have more, time accumulation, or we have more time for, this pattern to play out at this UT80 point, because people have to sell it at this high point. So when we see that, we tend to have a retracement of the Ethereum. So after the retracement, it tends to have a LPSY, and it goes down. So basically, it's following the table like Wyckoff. What do you think about that, John?
Yeah, one thing we have to be careful is the UTAD test, and that one is actually the first after distribution. So this whole period, this whole period is actually a distribution scheme. So basically, the investors bought down below, they distribute their Ethereum at they try to get the best price as possible. So they're gonna distribute at the top. The signature UTAD test is what distinguish reaccumulation from a distribution pattern, because in a weak accumulation pattern, we wouldn't have a UTAD test. We will have a spring instead. And that UTAD test is a sign of weakness, because it tried to break out, right? We tried to push through the resistance line, but we failed. And that's a rejection of higher price, because sellers will come in, they put enormous selling pressure at the top, and then that's why we are seeing a price reversal. And now we are doing we're in a markdown period, and we are going to see some bearish development of ETH. Yeah, Dave, you have anything you want to mention?
Let's jump on to the smart money logic, should we?
Yeah, yeah.
So basically, what we want to talk about smart money logic is like sort of like we observe anything that we can bet on, and as a leading sort of like a qualitative leading information or leading indicator for us to place some bets or trades. So no investment advice, no trading advice. Though I want to address like for the CPI and also inflation, we tend to have seen what's the commodities or what's the ingredients that compose with the CPI or inflation. So when we saw it with the June 10th, we can see that U.S. oil and steel are decreasing prices. Although we tend to see in the States that we tend to have a lot of gas prices that is going to all-time high, that people can't afford it. You can't afford it. I know maybe I can afford it, but sort of like it goes down in down channel. So still it's also a commodity that constitutes to the as a leading indicator for the economic recovery. It's like steel is used for construction. So in basically at the beginning of a economic cycle or recovery cycle, basically when the economy grows, more steel it's going to be used, and it just like drives the demand still. So basically, if we see that we have a reverse pattern that still is going down, we tend to have a sort of like recession coming, or a signals recession, whatever you call it. But it's sort of like a signifies a probability of a recession. So what do you think about these commodities or the prices, Johnny?
Yeah, we're seeing commodity prices going down, and that's good, because we are finally seeing the result of the Fed trying to bring down the inflation rate and bring down these commodity prices, and they did it. I don't know if they are going to push these prices down furthermore, because I doubt that if they continue, and then we're going to see some I would say they would say economic slowdown, but I would say recession, right? That's we gotta figure out what a recession is. If a recession means that economy slows down to a level that two consecutive GDP is negative, and then maybe different people have different opinion regarding what a recession is, but bad economy is what we don't want to see, and these prices going down temporarily. I think the Fed is telling us that the inflation has been curbed, and they are now trying to fix it, and that's a result. We're seeing it.
Yep. So basically, the Federal Reserve is trying to choose between like controlling inflation or a technical recession, where whatever you call it is a recession or not, based on the White House article. But basically, we also see that the WTI crude oil, like the copper. So basically, these two commodities are also decreasing since the peak of the CPI, June 10th. We tend to see these commodity prices are driving down the supply, to the supply of the market. So like what's copper? Copper is also similar to steel, but it reacts like more, having more tendency to react. Because like copper is basically used to produce like electricity cables and some large cables to infrastructure building. So if we have a start of the economic growth, we have to use copper to also a lot of demands. But what we are seeing is the opposite. So the opposite is of economic growth is economic slow down. So also we can see the soybeans, corn prices are also decreasing. But basically they are not only signaling a decreased inflation, they also signified a start of a recession from the standpoint of the commodity. So basically, when if you see that a lot of food prices are driving up in the states, yes, because a lot of money printing, but their prices are also decreasing. But I'm quite pessimistic about like these prices that we may have a probability of recession. So although I'm biased with the commodity price decrease, so what do you think about that, Johnny?
Yep, there's a probability that we are, going to enter a period of recession because, you know, slow economic growth equals to bad economy, right? We want to see exponential economic growth so that we can, you know, you can enjoy the gains on the chart. That's what we want to see about. I'm just kidding. That's a probability that we are going to see a recession here. Um, and what these charts show, the crude oil, copper, soybean, and also the commodities, the prices of commodities falling down, is that the Fed is showing us that they are trying to bring down the prices, and now they did it, and that's what we know from these charts. Shall we move on to the next topic, Dave?
Cool. So the next topic is like the smart money logic is also watching or keeping an eye on the 30-year yield of the treasuries. So from this chart, we tend to see take a symbol TYX that's tracking on the 30-year U.S. Treasury yield index, and basically when there is like a recession, we tend to see a bell line that the Treasury yield decreases because like from a narrative standpoint, because like when the 30 year treasury bill yield is basically signifying whether investors are confident on the long-term growth of the US market of the federal like US government bonds and the treasury stuff. But if the yield falls a lot, it basically in narrative standpoint that long-term investors are pretty bearish that we have a sort of a pessimistic will on the long-term growth of the U.S. economy. So when there is a bomb of the treasury yield, basically there is like a QE or increase in monetary supply or increase in M1, M2 and stuff, and we tend to see a quick recovery of the economy and bailout or QE and stuff period, and then we have a tightening, a tightening period. So there's a tightening period that the Federal Reserve is aiming at a monetary tightening policy that is going to drag more liquidity from the market to produce a relatively healthier balance sheet. So basically, when there is no limit for tightening, the Federal Reserve will from the chart always do quantitative easing. So what defines the standard or the extent that if the Federal Reserve is going to stop tightening is basically when we see that we have to analyze the whether the Federal Reserve can pay back, or the corporate can pay back the cost of the money. So the cost of money is basically like a yield. For example, it's like this treasury yield for 30 years. So if the yes, companies can pay the cost of money, so this yield can be higher. So until the point that there's an equilibrium sort of assumption, with the equilibrium of whether the American corporates can pay back the cost of money. That's basically so one of the ingredients is the yield. So with another factor of the equilibrium is the treasury yield. So when these two components are in equilibrium, we tend to see a top. So basically, there are analysts saying that we tend to have to see a logo, all-time high of the treasury yield of the TYX index. So basically, they are seeing that at the time, maybe, probably, maybe they are going to stop tightening the monetary market in the coming future. So to my standpoint, I think that's just a probability, because if the Federal Reserve wants to do a lot of monetary policy, or like tightening, or just increase the or by no means like the decrease the unemployment rate, so want more jobs for the people, for a lot of sort of like healthy economy. So basically the Federal Reserve still has a lot of bullets to go with the sort of like monetary tightening policy, because economy is strong and stuff. So for me, if I take this information as a sort of like probability of my trading strategies, but I don't take it as a whole picture of my trading strategies. So what do you think about this macro analysis, Johnny?
Um, yeah, maybe we are going to see, a, a falling index and this chart at 30-year yield, because as you mentioned, when we are, the economy is not good, the yield falls. And I think the only way that we can, see a reversal is, I mean, going up, is that, the Fed resumes the QE again, the print money again. That's how they can save the economy, but they sacrifice the strength of dollar, and that's the price they have to pay. And right now, we can't really tell that if it's going down or going up, because it's not in our control. It's Fed's control over whether to print money again or to do quantitative tightening. Is up to them, and that's why we have to stay tuned to the upcoming days that we have some important news about the monetary policy of the U.S., and we're going to remind you the dates in the later session. Dave, you have anything you want to discuss with me about this chart?
Probably let's jump on to the YY percentage of M2 supply correlation. So do you think
Yeah.
anything to add here?
Yeah. I want to bring out that the narrative of Bitcoin has been, people are talking about Bitcoin is inflation hedge, and that's why during QE, Bitcoin, the price of Bitcoin shot up a lot. But in my opinion, after reading this chart, I found out that the cryptocurrency market is actually correlates a lot to the total money circulating around the globe, and that's the M2 supply, global M2 supply. What it means is actually the sum of all money circulating around the globe, the total market cap of all currencies. And as we can see that in 2021, 2020 to 2021, we are seeing a lot of supply coming out from M2. The percentage change is is so great that it shot up to significantly, a very significant amount of increase. And after that, we see that the crypto market cap, the Bitcoin market cap follows. And there's a very clear correlation between the two, the Bitcoin market cap and also the global M2. And it actually makes sense, right, Dave? Because when there are more money circulating around the globe, investors tend to put money in investment, especially something that has a limited supply like Bitcoin. Actually, um, it is a inflation hedge when the M2 supply shot up, right? What do you think about it, Dave?
Yeah, so basically we have to check on is like the energy supply is increasing. Like if there's an increase of the year over year, global M2 supply is driving up the liquidity on the market, and people are going to have more wallets to bet on with the trade ideas, the trade, the investments. So basically, if we see that there is a YOY year over year change, sharp decrease or a U-turn of the and the total YOY year over year global energy supply, that's a big trouble. So this is a sort of like to me, it's a leading indicator of the Bitcoin market capitalization. So if you contrast that with Bitcoin year over year change in percentage, it's also having a similar balance that whenever sort of like in close time frame that the year over year percent change M2 global supply is having a closer peak time or all-time high time with the year over year return with Bitcoin market capitalization. So is basically an inflation hedge? Maybe is a inflation hedge with this narrative in a bull market, but given that capability is like also like a risky asset, so it's basically depends on whether people can bet on the supply and buy and sell, the trade and stuff on on this sort of like commodity. So what do you think about that, Johnny?
Yeah, I have something that to add here because um people can say that Bitcoin is an inflation hedge asset, but ultimately it comes down to whether people have the money to invest in assets, right? When people don't have money, I mean, when the demand is so weak, I don't think Bitcoin will grow continuously, right? Because what drives Bitcoin's market cap is what it comes down to is the drive is demand, right? Demand. So where demand comes from, where is the demand? The demand comes from the investors around the globe, right? So when countries are having a a bad economy, and as we can see that a lot of things happen in the past few months, a lot of liquidity crisis happen across the globe, and that's signaling uh, some economic downturns, possibilities of this happening, and that's why we are worried that in a macro view, the demand will be weakened in the future because, as you know, being illustrated by some events like bankruptcy and also bank run, and these things are not very healthy to the overall market, and that's why I think we have to really consider the real demand driving Bitcoin, and that's what we have to analyze. We have to look for demand, where it comes from. Is there a possibility that this demand can return, or this demand can grow? Any supporting evidence, any supporting ground to come to a conclusion that, oh, we have more money now, people around the globe have more money to spend, and they have more investment ideas, and that's why with more money they are willing to spend and invest in other risky assets to for a greater return. And that's what I think about. Dave,
Yeah,
you have
so
anything you want to add? Yeah.
so let's jump on to the coming release dates of and the FOMC date.
Yeah,
So
yeah, yeah. Let's proceed.
basically, yeah, yeah. So people can track on the coming release of the important economic events or sort of like events. Like the consumer confidence, new home sales, the signals whether we are heading to a boom or bust cycle of the economy. Fed rate hike, Wednesday, like according to GDP, jobless claim, PCE, inflation index, and consumer, you know, um, confidence. Basically, we're having an eye on the GDP, or the year or the quarter-over-quarter change. So, do you have anything to add on here, Johnny?
Yeah. So next week, make sure you stay tuned because we'll cover these news so that you don't miss out. And if you don't have time to, follow this news, we'll wrap it up for you next week. So make sure you also listen to our podcast and our live chat next week. Yeah. If you have anything to say.
I'm cool. So, can you jump?
Yeah. So yeah, back to the Candy Drop event. So make sure you have the Huobi app, you register your account, and then you have the trading volume of any assets in the last 3 days accounting to 100 USD, and that's not a difficult task. And after trading 100 USD trading volume, and then you can have an entry to be lucky star to earn up to a 1,500 USDT. And we also have the double coupons for those who didn't win, and then the lucky star will get 1,000 USDT. So make sure you trade more using Huobi app, and then you register for the candy drop. And yeah, the prize is waiting for you. So, and also make sure that you come back to us next week, Tuesday, because we're going to cover the news happened this week. There are a lot of things going on here, and we'd love to see you next week. And make sure you follow us on Twitter, Huobi Research, and also I want you to smash the like button in the Huobi Live chat section. And yeah, thank you for listening, and see you next week. Peace.